Hello everyone, in this video I will explain what mutual funds are, what their pros and cons are, and how to buy them. Actually, there are already many videos on YouTube that explain mutual funds, but almost all of them seem to have some kind of sales element. What I mean is, in most existing videos, in the end they try to sell a website or a service. Usually, what they sell sounds like this. Wow, mutual funds can give 20% returns per year. Come on, buy mutual funds. Buy them through my platform. Click this link, blah blah blah, like that. This can be quite biased, because when the goal of explaining mutual funds is to sell something, many videos do not explain the negative side, such as the fees or the potential losses in mutual funds. So it ends up feeling like they are just selling sweet promises. What I want to do with this video is create something without any selling. I genuinely just want to introduce viewers to what mutual funds actually are, not only explaining the positives, but also discussing the potential negatives. Okay, let's start. So, mutual funds are basically a financial product where we, along with thousands of other people, meaning the investors, pool our money together and then hand it over to another party, which is a company called an investment manager, to be invested into various other financial instruments, such as stocks, bonds, and money market instruments. The type of mutual fund determines where our money will be invested. In Indonesia, there are usually 4 types of mutual funds that you can find. The first is money market mutual funds. If we invest in money market mutual funds, our money will be invested in deposits and Bank Indonesia certificates. Then there are fixed income mutual funds. For this type, most of the money will be invested in bonds or debt securities. Next are equity mutual funds. For this type, 80% or more of the money will be invested in stocks. And the fourth is balanced mutual funds. As the name suggests, for this type, our money can be invested in bonds, stocks, and also deposits. So why don't we just invest directly in stocks or bonds? What are the benefits of using mutual funds? Let's directly discuss the positives and negatives of mutual funds. Let's start with the advantages. The first advantage is the presence of an investment manager. What is an SBI? What are bonds? How do you buy stocks? If we, as ordinary people, cannot answer these 3 questions, and don't have the time to find out, then it may be better for us to invest in mutual funds. The idea is that the investment manager is a financial professional who is experienced and knowledgeable in investing. So we simply entrust our money to them, and they will think about how to diversify and how to generate maximum returns. In short, the advantage is that we can entrust our money to someone who understands investing and let them grow our money. The second advantage is that mutual funds can be bought in small amounts. With relatively small money, such as 100,000 rupiah, we can already start buying mutual funds. If we compare this with other financial instruments, for example deposits, to get high deposit interest rates that are roughly comparable to money market mutual funds, we usually need to deposit around 1 billion rupiah. For bonds, if we buy them ourselves, generally we must buy in multiples of 5 million or even 50 million rupiah to be able to invest in bonds. For stocks, we must buy at least 1 lot or 100 shares, and the price depends heavily on the stock price itself, which could be 50,000 rupiah per share. Generally, brokers also require a minimum fund placement of 5 million rupiah to start trading stocks. So this second advantage is that people who previously did not have enough money to invest on their own can start small with mutual funds, beginning from that 100,000 rupiah. The third advantage is that mutual funds can be sold at any time, or in other words, they are liquid. We can compare this with deposits, where we must wait until maturity before withdrawing the funds. With mutual funds, we can redeem them at any time. Now let's move on to the negatives, which are rarely mentioned by people who sell mutual funds. First, there are fees. Remember the investment manager who manages our money? Of course, we have to pay them. The fees for investment managers vary. Usually, there are 2 types of fees. The first is when we buy mutual funds, typically around 1% to 3%. Then there is also a fee when we sell, usually around 0.5% to 1%. So before buying mutual funds, don't forget to check and calculate how much the fees are. The second downside is the performance of the investment manager. This can also be a negative aspect because there are many times when the investment manager we choose does not deliver the expected performance. For example, the performance may be worse than another product from a different investment manager. Or even worse, an equity mutual fund might perform worse than the stock index. That can be disappointing, especially when we have already paid a 2% fee, but the performance is still below the index. So if we have the intention to learn about financial instruments or stocks, and also have the time to monitor and manage them, it may be better to invest on our own rather than through mutual funds. Another downside is that the NAV is not settled at the time of transaction. NAV is the mutual fund price that we see on the mutual fund list or menu at the bank. This is called NAV per unit, and it is calculated by dividing the total managed funds by the total number of units. This NAV is only calculated and settled at the end of the day. So when we transact during the day, we do not know at what NAV price we are buying or selling at that moment. This issue becomes worse when we buy through banks, because when purchasing mutual funds at a bank, we usually have to transact before 12 noon to get the NAV price of that day. So if we buy at 3 in the afternoon, we will get the next day's NAV, and we won't know what price that will be. For equity mutual funds, there can be significant price changes at the end of the day that do not match our expectations. For example, we might expect to buy at a low price, but if prices rise in the last half of the day, we end up buying at a higher price than expected. Now let's talk about the risks of mutual funds. This is also something important that is rarely mentioned by people who sell mutual funds. However, I do not include risk as a negative point, because risk exists in all financial instruments, whether mutual funds, bonds, or stocks. What's important is that before investing in mutual funds, we understand the risks. For money market mutual funds, the risk is the smallest because our money is invested in deposits, so the returns are similar to deposit rates. In 2017, for example, the average return was around 4 to 6% per year. The risk is that if the Indonesian economy suddenly collapses, deposits are still guaranteed by the Deposit Insurance Corporation, meaning if a bank goes bankrupt, deposits up to 2 billion rupiah are protected. However, money invested in money market mutual funds does not have such a guarantee. As we move into fixed income mutual funds and balanced mutual funds, the risk becomes higher because bonds and stocks are involved, which means there is a risk of price declines. For fixed income and balanced mutual funds, returns in 1 year can sometimes be 3 times higher than deposit returns, but because of price fluctuation risks, it is also possible that in 1 year, the return is even lower than deposit interest depending on bond and stock prices. Lastly, equity mutual funds carry the highest risk, although they usually move not far from the IHSG index. If we choose the wrong timing or the wrong investment manager, it is very possible that over 3 years our money keeps declining and never makes a profit. That is the risk. Equity mutual funds are often associated with promises like returns will be 20% per year. In reality, even the best mutual funds average around 12 to 16% per year. That's the best case. Others can vary widely over a 5-year period. Some funds may only generate 4% per year or even less, which is lower than deposit returns. That is the risk of equity mutual funds. The next topic is how to buy mutual funds. The easiest way to buy mutual funds is through banks. It's easy because we already have a bank account. There are 2 ways: by visiting a branch or online. If we go to a branch, we need to meet customer service or a relationship manager. Not all branches and not all customer service staff can sell mutual funds because special certification is required. At branches that do offer it, we choose the mutual fund, fill out the form, and the bank will automatically transfer our funds from our account to the investment manager. This can be done at banks such as BCA and Mandiri. Second, there are some banks that are more advanced, usually smaller banks. With these banks, we don't need to visit a branch to buy mutual funds. We can do it online or through a mobile app. This saves a lot of time because we can transact from anywhere. However, if we don't already have an account at these banks, we still need to visit the branch once to open an account, activate the app, and activate mutual fund services. After that, we can buy mutual funds through our phone. 3 banks that I know offer online mutual fund purchases are Bank Commonwealth, Bank Permata, and Citibank. Besides banks, there are many other ways to buy mutual funds. We can buy them through securities companies, and more recently, even through e-commerce websites such as Tokopedia and Bukalapak, which now sell mutual funds. There are also websites dedicated specifically to mutual funds, such as Bareksa. The downside is that there are extra steps to create accounts on these platforms, and every transaction still involves additional steps with our bank account, either through transfers or mobile banking. However, one additional advantage of using securities firms or newer platforms is that the fees are often lower than banks, and sometimes even free. That's all for my explanation of what mutual funds are. The main point is that if we have the time to learn and monitor bonds and stocks, mutual funds can be a more suitable option. What's important is that we make sure we understand all the risks and fees before starting to invest in mutual funds. Even so, I still encourage everyone to start investing as soon as possible, whether it's in deposits, mutual funds, or stocks. We need to start learning, and we need to start as early as possible. If later I think of a way to explain mutual fund strategies, I will make another video. If you have any ideas or questions, feel free to leave a comment below. Thanks for watching, and see you in the next video.